Hey there, it's Linda Hayes. If you want to understand cash flow statements, in this video we're going to talk about how they work and give some examples. First of all, if you're looking at your income statement and you had a net income of $330,000, that doesn't mean that's how much cash you have. That is based on accrual accounting. So the first step we do in our cash flow statement is analyze everything on the balance sheet that had a change in cash. So on the operating activities section, we start first with the indirect method with net earnings. So in this example, you can see the 330 I just mentioned. Then we have to do all of our adjustments for items not involving cash. So you'll see depreciation expense at 200 here. That's the first item that you'll have for almost every company. Because depreciation decreased net income, to get it out of net earnings, we have to add it back. So that's why it's a positive number there. For the gain on sale of equipment, you can see that that's deducted, and that's because gains when you sell are added into net income, so we have to do the opposite and deduct it. The next thing we have to do is look at all of our current assets and current liabilities and see what has happened. And we'll go through more details on this when we do the examples later on. But you can see here we have AR, inventory, and AP in that section. So that is basically what we're looking at for operating activities, is taking out the impacts of accrual accounting. Now, the next section is investing activities, and here you're analyzing all your long-term assets on your statement of financial position. So the one in this example is equipment. If we sell equipment, well, we already showed that we had a gain on the sale back in that net operating activity section, but really the cash in and out from equipment is going into the investing activity. So any change in investments and equipment, land, anything here is where you put it. So for proceeds of sale of equipment, we got $130 cash in our bank, so that is an inflow in the investing activities. We also bought some new equipment, so of course that's a cash outflow, and in this example it's $410. So anytime you have sale or purchase of bonds, of stocks, equipment, land, buildings, all of those things will go into the investing activities section. Now, the financing activities section. Well, this is where we go through the remainder of the balance sheet to see what happened with cash. So that would be your long-term liabilities and equity. So you can see here there was an increase in a current bank loan. So the bank gave us some more money, so that's an inflow of cash of $15. We paid some dividends out. That's in the equity section. While dividends paid, reduced cash. So you see a negative $225 there. We also paid off some of our notes payable, and when you pay off money, well, cash goes down, so you see negative 30 there. So that is how financing activities works. Basically, all of your long-term your long-term liabilities and your equity, all the cash components go through financing. Then, once you have finished your operating activities, investing, and financing, you see there's 485, 280, and 240. And once you net all those out, you can see that there in this case is a decrease in cash of 35. Then we take our cash from the beginning of the year, which was 90, and at the end of the year, our calculation says cash at December 31st should be 55. If that matches the balance sheet or statement of financial position, that means you've done this correctly. Now let's look at some other examples from the textbook. Here, TR5-3. So this is cash from operating activities. And it tells you here selected accounts from the statement of financial position. So the balance sheet at Gabby Inc. at December 31st, 2007 and 6 are presented below. And that Gabby had earnings of 125 in 2007 and depreciation was 20,000. So the way that the cash flow statement works is basically that we have to adjust different things. And I'm just going to try to make my screen so that I can show Excel for you as well. Okay, there we go. Now I'm going to open up Excel. And we're going to go through and do this problem just to give you an idea of how the cash flow statement works and talk about some of the stuff I would go through in class, just because this, again, is one of the topics I think that students struggle the most with in this course. Okay, so it says calculate cash from operating activities from 2000X7. Good form is not required. So basically here, the idea is on a cash flow statement, we want to figure out what went through a company's bank account. And if you look at the income statement, you can kind of see things that they got in and things that they got out. But the problem is there are things that they didn't pay cash for because we do accrual accounting. So when we're doing the statement of cash flows, there's two ways you can do the operating activities section. So the first way is called the indirect method for operating activities. And that is the way we're going to do this one. And in this course, that's the only one you're required to actually do is the indirect method. For the direct method, basically, you're doing it where you're figuring out the cash that people paid you and expenses you paid. So here we have accounts payable, rent payable, inventory, etc. But if you were doing the direct method of cash flow, you wouldn't really be looking at these accounts by itself. You would have to consider in accounts payable, what payments did we make to vendors? And we would put that in the operating activities section. But when we're doing the indirect method, what our starting point for the cash flow statement always is going to be is net income. Because if all of our net income was cash, then that would be our cash flow statement. So for example, say you run a convenience store and you have all cash sales and everything you buy is paid in cash. I mean, that's a very unlikely situation in today's world. But if that happened, your net income, revenue minus expenses, would agree to your bank statement. But because that does not happen, what we're going to do is we're going to start with net income. And in this case, the question told us it was $125,000. I'm just going to format my numbers here just so it's a bit better. So there's my net income. Now, the problem with doing a cash flow statement is there are items that do not require cash, and we have to back these out. So these are going to be called adjustments. And basically, it's for items not affecting cash. So that's the first thing we have to do. So adjustments for items not affecting cash. So what type of items would those be? Well, one you're going to have in every single cash flow statement pretty much is depreciation expense. And the reason for that is that companies depreciate their assets, but when you do a depreciation entry, it's debit depreciation expense, credit accumulated depreciation. There's no cash in that entry. So that expense is a non-cash expense. Now, because depreciation came out of this income, right? It was taken out. To get rid of it, we have to do the opposite and add it back. So because it's an expense that's non-cash, we're going to add it back. And that's the first rule I want to talk about for cash flow statements. Whenever you have a non-cash expense, I'm just going to put this on the side for everybody. So a non-cash expense, you're always going to add it back to net income so that it's basically saying that expense didn't happen in terms of the bank, which it didn't, because again, depreciation, we debited depreciation expense, credited accumulated. So to back that out of net income, I'm going to have to add that depreciation. How much was it? Sorry, it was in the question here. Depreciation expense was $20,000. So I'm going to add 20,000 to that one. And in this question, there's no other things that are non-cash. What other things might you have? Well, some of the other problems you're going to do also are non-cash. And an example of that would be a gain on sale. I'm just going to use that as an example. But like a gain, well, actually, first I'm going to say non-cash income. And an example of that would be, i.e., a gain on sale. So if we sold a piece of equipment, basically our entry there would be debit cash for whatever the cash was. We would credit the equipment that we sold, and we would credit gain if we made more than what the cost was. Well, that gain itself isn't cash. The cash is what we actually received. And for the first part of the cash flow statement, we actually have to deduct any gains that are non-cash. So this is just general rules for the cash flow statement to start with. I'm just going to put that in bold. So rules, non-cash expense, you're going to add back in operating activities. Non-cash income, you're going to deduct. And in this case, the only thing we had was depreciation. So we're adding that back, and that gives us the total that we need to do here. So I'm going to just add those two things together. And so that's my starting point, is the 145,000. And we don't really need a subtotal for this because this is just our number when we've added back or subtracted any non-cash items. So that's the first step. Then what we have to do is we have to adjust for all of our current assets and current liabilities. And the way this works, I'm going to first start with the heading, changes in current assets. I'm going to abbreviate this, current assets and current liabilities. And the reason we're doing this is when you think about current assets and current liabilities, if we had inventory and we bought more, it means we paid more for it. Now, you do sell inventory and receive cash, and you buy inventory and pay cash. The way you can calculate the change in cash related to inventory is by analyzing what the inventory is on the balance sheet this year, which is 72,000, versus last year, 68. So I'm going to start in here with, well, the first item is prepaid insurance, and that's a harder one to explain to students. So I'm going to just type the different items here, inventory. Oops. We have rent payable. And we have accounts payable. So basically, these are all the accounts where we do accruals. And to figure out how much we need to adjust here in the operating activity section, we have some rules we could follow as well. So we have these first rules, and we're going to add some more for this section. So if we have an asset that goes up, we're going to do one direction for it. And if it decreases, we're going to do the opposite. Then we have like, and I should specify this is for current assets only. And then we have current liabilities only. And then we also have, oh, sorry, I should put that down here. And we have to talk about each of these type of items. So basically, in our operating activities section of our cash flow statement, our changes in current assets and liabilities go there. So we always start at net income, we adjust for non-cash items, and then we do our changes in current assets and current liabilities. So basically, the way that it works is if you buy more inventory than you sell, you're going to spend money doing that, right? So if your current asset increases, like in this case, we had inventory of 72 now, where we had 68, we have more inventory. That means we spent more cash to buy inventory than we actually got selling it. So the direction goes in the way we just talked about. So if your inventory increases, your cash decreases. So this is the, I'm going to say this is the account, and this is cash. So what happens with cash? Well, if your current asset increases, cash goes the opposite way, so it decreases. So always for current assets, you're going to go the opposite way. So that's the rule I wanted to tell you guys, is that if your current asset increases, cash is always going to decrease. If your current asset like inventory went down from last year, then this would obviously increase. Okay. So hopefully that makes sense to people. And then when you're looking at current liabilities, it's opposite of what we're doing on the assets. So here for current assets, we said that everything goes opposite for cash. If your asset goes up, your cash goes down. Well, for current liabilities, if it increases, say we owe vendors more money than we paid, that means our accounts payable went up. And in this case, it did. We owe them 61,000. Last year, we only owed them 46. That means we didn't pay them as much this year because there's more owing. So basically what happens with that when your account for current liabilities increase, that means your cash also increases because you paid less. And so this goes the same direction. Okay, so hopefully that helps people with the rules. So the rules is for current liabilities. If they go up, so does your cash. Current assets, if they go up, your cash goes down. So it's the opposite. And that's the rule. If you don't remember everything, just remember these rules I'm giving you here, and that'll help you with your cash flow statement. Now, we're actually going to go through, follow these rules to do this section. So we already covered the non-cash. We added back depreciation expense. If we had a gain, we would have deducted here. But for the other pieces here, it's easy enough to do. So for prepaid insurance, that is an asset account. And we said, well, when an asset goes up, that we would increase it. If the asset went down, we would increase cash, right? So it's basically the opposite direction. So in this case, what happened? Well, prepaid insurance is less than last year. So that means we need to do a decrease in prepaid insurance. So when we're doing the decrease, you're going to you could type it right in your question. You could say this is a decrease in prepaid insurance. I didn't put it yet because I hadn't calculated it, but I'm going to say it's a decrease in prepaid insurance. So then this means this has to be a negative, right? And I don't have to put the negative in because it says the word decrease, but I'm going to do it to make it simple. So the question is, how much did prepaid insurance decrease by? Well, in this case, it decreased by 16 minus 4 is $12,000. So that's the adjustment I'm making here. So it's the change in prepaid that we're recording. Okay, inventory is another asset. So it actually went up. So it's 72 now. It was 68. So if inventory went up, we look here, current asset, it increased. So cash has to decrease. So it's the same direction here. So we have to have negative 4,000, right? Because 72 minus 68 is $4,000. Oh, wait, did I do that the right way? Let's see here. No, sorry. What happened with the prepaid? The prepaid went down, so I had to add it. I don't know why I was subtracting it there. Sorry about that. Let's fix that up. So it's a decrease. We have to do the opposite. I typed decrease and then I put a bracket, negative there, and you can see that's why I said this is the more complicated section, because you have to actually look again at your, even though I typed decrease because this is an asset, I do an increase in cash. Here, inventory was actually an increase in inventory. So because it's an asset, we do the opposite and we subtract the change in inventory of 4,000. Now we're looking at rent payable, which is the one I was thinking of when I was doing prepaids. But for rent payable, when you look at that, now we're in the liability section. So rent payable and accounts payable are liabilities. So you can see AP went down. So if AP went down, that means cash goes down, because remember, liabilities go the same direction. If they go up, cash goes up. If they decrease, then cash decreases. So in this case, we're going to deduct 3,000 because it goes the same direction. We had a decrease in rent payable. I should type that in the description here, decrease in rent payable. Then in AP, what happened? Well, we had an increase in accounts payable. Well, again, if that went up, that means cash went up. We paid vendors less, so we have more cash on hand. And you can do it as a formula in here too. 61,000 minus 46,000. And there we go, 15,000. So hopefully this example shows you how to do cash from operating activities. So basically, we've taken our net income as a start, added non-cash or deducted non-cash as appropriate, and then every single current asset and current liability gets adjusted through here. And at the end of the day, that will give us our cash from operating activities. So I can just do a formula here. Gotta find where my formulas are when I'm not in full Excel. I'm just gonna basically make this full so I can see my auto sum, and it's that plus all of these. And here is my cash from operations. So this matches the solution that you'll find. The cash from operating activities is 165,000 in this specific example. Now, the next thing I want to do again, because cash flow statement is the hardest, this one is just operating activities. But other questions you can look at, even if you're just wanting to do a few of the homework questions to start with, I would make sure you do the next ones being TR5-5, which is investing activities, and then TR5-8. This is a good introduction of financing activities. And I want to just talk, I'm not going to do these problems the same way, but what I want to do is just talk a little bit about these different sections. So when you're doing your cash flow statement overall, your current assets and current liabilities go through operating activities, as I already mentioned. When you're looking at your long-term assets, those are going into the investing activities section. And you can kind of see that right when you look at the question, but you have all of your property, plant, and equipment, and any investments would go into the investing activities section. And here, you're basically going to figure out how much cash you received from selling equipment or how much cash you paid for buying equipment, and the same thing for investments. So equipment, buildings, stocks, bonds, land, anything like that would go through investing. So this is for your long-term assets. So I'm just going to type this in that Excel just to remind you. So investing activities is where you put all cash from long-term assets. So again, when we did operating activities, it was current assets and current liabilities. Investing is all cash from long-term activities. And then the last section of the cash flow statement is financing activities. And for financing activities, I'm just going to type it in here. Again, these are the rules that you can kind of think about when you're doing a cash flow statement, because we're going to look at the balance sheet to analyze all of the accounts, basically, but we're also starting with our net income here and adjusting for non-cash. So on the financing activities, this is going to be all of your cash from long-term liabilities and equity. So you can see it again in the question, but basically, if you look here for financing activities, you can see it's if they have cash dividends, well, you pay cash for dividends. Bonds, you either buy bond, like you have some transactions that are related to bonds, common shares, maybe you issue more shares. This is a equity account, retained earnings, of course, being an equity account as well, where companies pay dividends. Now, one thing I want to also mention about financing activities and investing activities is sometimes you have to solve for something they don't tell you in the question. So in this particular question, just to give you an idea of what I'm talking about, it says make logical assumptions about unexplained changes in accounts. And one thing I want to show is that in this question here, for example, it says that retained earnings is 225 this year, and it was 250 last year. Well, that means it went down by 25,000. Everybody can see that there. Now, when you look at what net income is, it says net income was 100,000. Okay, well, if you started with 250, right, and you added 100,000, you would have 350, but you only have 225. So it does tell you there was a stock dividend valued at 50,000 that reduced retained earnings. So basically what we could do, I'm just going to do a quick retained earnings example for you with this one in mind. Retained earnings. So when you're doing a retained earnings T account, and this is what I recommend doing for every cash flow statement you have, I would start with net income. And that's going to be, actually, I should do it as a T account. So here we go. Let's just, can't find well, I'll just put net income here as a starting point. So net income, well, first of all, I guess I need my opening balance. So let's do beginning balance. So in this question, the beginning balance, this is TR. I'm going to break the question number here. This one is TR5-6. So my beginning balance is in the credit column. So I'll just move my T account up. This is going to be debits and credits. So my beginning balance in retained earnings is $250,000. There we go. So that's what I started with. Well, my net income is also going to increase. I'm going to format this so it looks like an actual T account. And I know we have some lines or something in here. Let's just make this bigger for a second so I can format this a little bit better. There we go. Now that looks like more like a T account that you'd be used to seeing. Okay, so beginning balance, we started at 250. You can see in the question here. We know that we added net income. It tells us it was 100,000. So we're going to add that in, 100,000. Then we know we take dividends out of retained earnings. The journal entry is debit dividends, and it goes through retained earnings because we credit cash, of course. But this one isn't cash. It says it's a stock dividend, but we still know that it has to come out of retained earnings, 50,000. Okay, so hopefully everyone's following this so far. Now, if we look at this, our retained earnings should be 250 plus 100, 350 minus this, it should be 300,000. Well, it's not, it's 225. So what does that mean? Well, it also means that, and it tells you this, there was also a cash dividend declared and common shares issued for cash. So this one isn't an assigned problem. That's why I'm doing it as a demo, because you have another financing activity one here you can practice. But basically, because you need your closing balance, we know we need it to be 225. That is our answer at the end of the day. Let's just go here. I'm just gonna put my little highlight here. So basically we start at 250, we add 100, we took out 50. What do we need here for the cash dividend? Basically, this is something we have to solve for. We don't know the answer. But if we say, okay, well, we started with 250, we added 100, we minused 50, and we need to get to 225, our cash dividends have to be 75. So that's one of the things that you always want to calculate to make sure you're not missing something on the cash flow statement. This one told you there's a cash dividend declared and there's common shares issued for cash as well. So those are things you have to calculate. I just showed you the cash dividend declared. Common shares is another thing we would have to look at. So common shares, it says there's 100 and then there's 400 now. This one's a little more complicated because we also had increase of common shares of 50. So basically what you would say is, well, I started with 100. I know I had 50 more that was a dividend, so had no cash. So we're at 150. Well, we got up to 400. The rest would be actual common shares issued for cash. And that would be an item on the financing activities as well. So basically, I would recommend that for all of your long-term liabilities for investing, or sorry, for financing, and all of your long-term assets for investing, that you do T accounts to make sure you solve for items the question doesn't tell you. So I showed it to you for retained earnings here because it's one students commonly have problems with. But in addition, on investing, there are times it tells you, like in this question, a new machine was bought in 2000 X5, 25% of the cash is paid in cash and the other 75 financed directly by the vendor. So again, that is one where you have to calculate how much did they pay for equipment. And you can see here, you basically see the change in the equipment, but they don't tell you how much they actually bought it for, right? So you have to calculate that. And so they give you all the numbers to do it. And I'm not going to go through this one with you because again, I want you guys to try to do it on your own because this is one of the ones to practice for homework. But the idea is you would do an equipment T account. You would start with your opening balance. You would add any purchases, which you don't know in this case. You would deduct depreciation because this one is net of accumulated depreciation. And then you can kind of end with your ending balance and see what you actually paid for the new equipment. And once you know what you paid for it, you know that 25% is in cash. Hopefully this summary gave you an example of how cash flow statements work, and the key is practice.